Welcome to Personal Finance for Long-Term Investors, where we believe Benjamin Franklin's advice that an investment in knowledge pays the best interest, both in finances and in your life. Every episode teaches you personal finance and long-term investing in simple terms. Now, here's your host, Jesse Kramer.
Hello and welcome to episode 108 of Personal Finance for Long-Term Investors. My name is Jesse Kramer. I'm a former aerospace engineer turned writer and podcaster talking about personal finance. And for the past 3.5 years, I've been a career changer too. I'm no longer working on spacebound satellite systems, but instead working directly with busy professionals and retirees at a fiduciary wealth management firm in Rochester, New York. And here in episode 108, it's going to be an AMA episode. And as always, listeners, I encourage you to send in your AMA questions to my email address, jesse@bestinterest.blog. And if you want to listen to my past AMA episodes, they've been my most popular episodes I've put together. I've put them all in one place on my blog, so we'll throw a link in the show notes, just one link, and that way from that page you can find all my AMA episodes. Today's AMA questions, will cover thoughts on whole life insurance, something that many of you have probably had pushed on you, but we'll discuss why it's usually a bad fit. We'll talk about the financial downsides of being single versus being married. Are the pros and cons of a long-term relationship? Are they worth it from a financial point of view? We will answer a question from a big earner and a big saver who has important questions on whether to utilize Roth or traditional accounts. And what about healthcare costs? One listener pointed out and asked today about all the major financial impacts in our lives. Healthcare costs might be the least discussed by the general public, so we'll dive into healthcare details throughout the various stages of life. And the last question today, 2 listeners asked me questions about this year's interesting regime of tariffs, uncertainty, possible recession, other economic ramifications. We'll talk about that topic a little bit. Let's start, though, with a customary review of the week. This one comes from Spidey314, who left a 5-star rating and a review on Apple Podcasts and said, "Outstanding voice of reason in a crowded market of finance podcast. Jesse's podcast is an excellent resource for both beginners and experienced folks alike in the realm of personal finance. Not only does he give solid and well thought out advice, but he also shares his evidence so you can draw your own conclusions. He takes the time to give well-rounded responses to his listeners' questions, as well as bringing in other industry experts to discuss various topics. I've learned something new from every episode, even if it's a topic I've already heard discussed before." Well, Spidey, thank you for the kind words. Shoot me an email to jesse@bestinterest.blog. We'll get you hooked up with a super soft t-shirt. And I will announce we've got new t-shirts coming, not branded for the Best Interest podcast, but instead branded for Personal Finance for Long-Term Investors. So listeners, if you want to get your free t-shirt, leave a rating and review, and eventually we will get to you and mail you out that t-shirt. But now on to the AMA. Question 1, as I alluded to, it's a twofer because I got very similar questions from both Cole and John. Thank you guys for the questions. Cole asked, "Hi Jesse, an insurance agent is telling me that my current accounts will get penalized when I pass away and that my children will have to pay those penalties. Instead, he is suggesting a whole life insurance policy. For details, the current accounts are an IRA with my kids as 50-50 beneficiaries and a taxable account, which goes to my kids in the will 50-50. What are these penalties? And is this the place where whole life insurance makes sense?" And then listener John asked a different whole life question. He goes, "Jesse, I know it's probably time for me to consider getting life insurance. Some people I've talked with say financial advisors don't like the idea of life insurance for some reason. What are your thoughts on life insurance as an investment?" So 2 awesome questions, guys. These questions probably rhyme with some of the questions floating around our other listeners' heads. A few things to unpack first. So let's discuss the different types of life insurance, whether that's pure insurance or using insurance as an investment of some sort. Let's also make sure we talk about the penalties from Cole's question, right? And we have to answer this bigger question. Do certain account types get penalized when you pass away? And is life insurance the way to circumvent these penalties? And then from John's question, we want to make sure we address, why do some financial advisors love life insurance while others seemingly do not? What exactly is going on there? Okay, first things first, there are 2 major categories of life insurance, term and permanent. Term and perm. The difference is right there in the names. Term life insurance has a specific time period, a specific term attached to it. It's common to see, for example, 30-year term policies. If you die within those 30 years where you hold the policy, then your beneficiary or beneficiaries get the payout of the life insurance. But if you don't die within those 30 years, then nothing happens, except that the insurance premiums that you've been paying all along the way, you've lost those premiums and you have nothing to show for it. Term insurance is what I'd call pure insurance, right? What I mean is there's a premium that you pay In exchange for the insurance coverage, you shift your risk, the risk of your death in this case, away from your balance sheet and onto the insurance company's balance sheet. But if that risk, your death, never occurs, well, the insurance never pays out, nothing ever really happens, and all you've done is pay money for nothing in return. But that's the way pure insurance works. Now, permanent life insurance, as the name implies, lasts forever, as long as you keep paying your premiums along the way. Most of the time, permanent life insurance policies will go by one of their sub-names, I'll call them. For example, whole life insurance or universal life insurance or variable life insurance. These are all types of permanent insurance. And permanent insurance is more than just pure insurance, because somewhere, someone along the line thought that there was a problem with term insurance. As we've already discussed, with term, you might be paying $2,000 a year as your premium for 30 years. And if you don't die, you get nothing back. If you die in year 31, you get nothing back. So you might be paying tens and tens of thousands of dollars over the course of a term policy, but if you don't die, you don't get anything in return for that. Now, I would argue that having your risk covered along the way is the point, and that risk is covered whether you end up dying and realizing that risk or not. But still, some people would say, I want something back. If I'm putting money into the insurance policy, I demand to get something back. Like I said, someone in the insurance industry thought to themselves, well, first, let's make an insurance policy that never dies, right? It's a permanent policy. And second, let's make it more than just pure insurance. Let's add a compounding real value to this product, a cash value, or an investment aspect to the policy. So every year, a portion of the insured person's premiums will grow this cash value of the policy. So perhaps at age 60 or 70 or 80, the insured person, they'll say to themselves, rather than waiting to die, and rather than having my beneficiaries receive the benefit of my policy, why don't I start spending some of this cash value myself? So in that way, it's not only life insurance that will pay beneficiaries upon someone's death, but it's also a savings and investing account all tied into one. Now, is one better than the other? Is term better than permanent or permanent better than term? Well, first, I'd encourage you to do some of the math or you can trust my math here, because both term and permanent life insurance policies provide death benefits, provide insurance. I've been saying pure insurance all along. Really what I mean there is a death benefit, right? It insures you against a specific risk. So in that way, they're the same. They both provide a death benefit. The permanent policy, though, has a much higher premium, in order to fund the cash value or the investing side of the policy. In other words, a permanent policy is going to be much more expensive over your life because it has this compounding cash or investing side attached to it. So our math problem becomes pretty clear. Would I rather pay the higher premiums of the permanent policy and let the insurance company control my investments? Or would I rather pay the lower term premiums? I'll keep the monetary difference of the premium values. I'll keep that in my own pocket. And then I'll invest that money myself according to the traditional investment tenets that I discuss here on Personal Finance for Long-Term Investors, or that I write about over at the Best Interest blog. Now, by my math, if you look over a 30-year timeline, where you could choose, for example, to invest $500 a month into a whole life policy, or you could put that $500 a month into a more traditional investment account, the difference in the final portfolio value between those two scenarios will be on the order of $1 million. The person who chooses to invest the money themselves and not throw the money into a whole life policy, the person who invests themselves will have an additional $1 million after 30 years. That's why I avoid whole life policies, and that's why I don't recommend that my clients or that you listeners go out and get one. We can take a more cynical point of view as well. And the cynical point of view is to say, well, why are whole life insurance policies pushed so hard by insurance companies in the first place and by the salespeople of those companies? Why are the term policies recommended usually by people who don't have a dog in the fight? And this is getting back to part of John's question. I think if you asked an insurance salesperson, they would probably recommend whole life or another permanent life insurance policy all day. They would push. They would even go so far as to use dishonest numbers to do so. I could go on social media and find 5 of these people in the next 5 minutes. And for reference, I almost guarantee that one of the things they would do is show you stock market returns without including dividends. And dividends are one of the only 2 components of the way that stocks produce returns. So to show stock returns without dividends is a pretty fundamental error. And yet, in almost every whole life insurance sales pitch that I've ever seen, that's exactly what they do. Meanwhile, virtually all financial educators that I know, they recommend a simple term policy. Virtually all of the independent fiduciary advisors who I know, including my own colleagues, we recommend simple term policies. The people who don't have a dog in the fight, the people who don't earn money off of insurance commissions, they almost always recommend term policies. And the people who are legally obligated to offer best interest advice to their clients, well, they recommend term policies too. Now, the only curiosity that I've found in this space, and I think that you might find in this space, is when someone, say like a CFP, a certified financial planner, who happens to work at an insurance company, right? CFPs, they have an ethical fiduciary obligation. It's part of the CFP training and part of their their commitment to the CFP values. It's an ethical fiduciary obligation. It's not a legal one though. So when an insurance salesperson gets their CFP, some of them will do the right thing and essentially stop selling whole life policies because ethically they realize that it's not in the best interest of their clients and they feel like following through on that commitment they made. Others, though, will find a justification in their minds that the whole life policy somehow fits into the best interests of that particular client. It's very interesting. So that is a corner case where you might find someone who is labeling themselves as a fiduciary. They do have an ethical fiduciary obligation, but importantly, because they aren't working for a independent fiduciary firm, they don't really have a legal fiduciary obligation. That's worth understanding the difference there. And therefore, they might actually push whole life insurance policies, even though I would argue that they shouldn't. Once in a while, though, when somebody is clearly dealing with federal estate tax limits, a permanent life and policy, a whole life, a universal life, something like that, a permanent policy can make sense. So this would be, for reference, we talked about, what's a federal estate tax limit that I just referenced? For a married couple, it's someone with approximately $30 million or more dollars. For a single person, someone with approximately $15 million or more dollars in their taxable estate. For them, and for the sake of liquidity needs upon their death, a permanent policy might make sense. But importantly, that's not because the permanent policy leads to a greater net worth for that person. That's not the reason why we do it. It's not because it's going to make them more rich. Instead, it's because estate taxes are due within 9 months of death, and the permanent life insurance policy provides a tax-free payout upon death. It's tax-free. Yes, these insurance policies, both term and whole, provide tax-free payouts because the payouts are not considered income. They're instead considered a return of capital. And I think that's just important to point out. The federal government, the IRS, the tax experts, they don't treat life insurance payouts as investment income because there often aren't enough gains in there to justify that. They simply classify them as a return of capital that the insured people have already committed into the insurance policy. It's not a way to become rich. It's just a way to return money to yourself over time. That's what these permanent life insurance policies are. Many wealthy people, many people flirting with these estate tax limits, they might be very asset rich, but there are plenty of times where they're cash poor and they simply can't liquidate, say, a $50 million business to pay their estate taxes. So instead, something like a permanent life insurance policy can provide that liquidity when needed upon death to help pay for estate taxes. Again, if you think this corner case applies to you, I'd recommend working with a trusted wealth management team and a trusted estate attorney to help you plan all this out. But for what it's worth, just because you hear to yourself that someone with millions and millions and millions of dollars happens to be owning a permanent life insurance policy, that doesn't necessitate that you ought to own one too. But speaking of death, we need to go back to Cole's question, because Cole asked as part of his question, do certain accounts get penalized when you die? Cole specifically mentioned his IRA, which I'll assume is pre-tax traditional IRA, and he also mentioned a taxable account. Well, the taxable account is easy. When you die, Cole, all of the assets in that taxable account will receive a step-up in basis, and your children will inherit those assets at that stepped-up basis. Now, in layman's terms, this negates any capital gains taxes. You won't pay them, Cole, your estate won't pay them, and your kids won't inherit those taxes. They essentially disappear. We've talked about this idea before on the podcast because it's certainly a little controversial on a macro tax level. So Cole, your kids could choose to sell those assets on the day they inherit them. They won't pay a penny in tax. Or they could keep those assets for the long run, let them grow, in which case their capital gain will be measured against the value when they inherited them, not against the value at which you bought them, Cole. To summarize, I guess, the gains that you realized while you're living, Cole, those gains become tax-free once you die. So any sort of penalty on that account is a mistruth or a misunderstanding from the insurance salesperson. But now, what about your IRA, Cole? Again, I'm going to assume it's a pre-tax traditional account, so those dollars have never been charged a penny of income tax. That's the way that pre-tax traditional accounts work. You get a deferral on your income tax. So when you die, Cole, and leave that account 50-50 to your two kids, they will receive the account via what's called an inherited IRA. And based on some recent changes to the tax code over the past, say, 5 years as of this recording, the most current policy, I should say, is that all inherited IRAs must be emptied within 10 years of the date of death of the decedent, which is basically the same as 10 years from when the kids inherit the money. So, for example, in this example, the kids, they've got to empty the account within 10 years. And because these are all pre-tax dollars that have never been taxed, they're going to owe taxes. So the kids might choose to withdraw a fraction of the IRA every year, 1/10 in year 1, 1/9 in year 2, 1/8 in year 3, et cetera, trying to kind of even out those distributions over the 10 years. And each of those withdrawals being from a pot of money that's never been taxed, each withdrawal will be considered income for the kids, and they will pay income tax on that money based on their current year tax situation. If they happen to be really high earners, well, that income tax is all going to get taxed at the marginal rate that they're paying, which is going to be a pretty high amount. If they're very low earners, maybe they're still children, they might not be earning much at all, they're going to pay a very low effective tax rate because that's the only income they'll have. This is not a penalty though, right? They're going to pay income tax out of the IRA withdrawals because you never did, Cole. It's just fulfilling the agreement that we all take with the IRS in the first place on these traditional accounts. Give us a tax break up front and we'll make good on the income taxes later. Is the income tax to your kids, Cole, is it so severe that you ought to consider a whole life insurance policy? Personally, I don't think so. The main reason is that whole life insurance policies are funded with after-tax dollars. And eventually the payout, again, as we already discussed, is tax-free because they're considered a return of capital, not as earnings or income. In other words, the IRS has looked under the hoods of these policies and said, yeah, there's not really much growth here. This is just the insurance policy returning your own premiums back to you. So we're not going to tax it as growth because it's not growth. So just as we talked about in one of the last AMA episodes, some people hate the idea of taxes so much. They're so diametrically opposed to taxes that they'd rather be in a situation with less money as long as that situation helps them avoid taxes along the way. They'd rather keep 100% of their grape instead of 50% of their watermelon. That doesn't make sense to me, and that's why I don't think it's going to make sense for you, Cole, to follow this whole life insurance advice at all. I'll leave that up to you and your own personal taste or lack thereof for taxes. So anyway, thank you, John, and thank you, Cole, for the great questions about whole life insurance. Let me know what you think. Question 2 is from Bridget, who wanted to ask us some thoughts on all the financial upsides and downsides of being single versus being married. Now, Bridget, the unfortunate truth is that much of our financial world is tilted toward benefits for married couples, some benefits that single folks simply don't have. Some of these benefits are written into law or into tax codes. Others are more what I would call benefits of circumstance that happen to play out in a way that favors being married. And I don't know about you, but the first place that my mind jumped to when I read this question, Bridget, was what I'd call economies of scale. You know, married couples, they get to share houses. They get to share utilities. They share homeowners insurance. They split grocery bills. They probably get to cook a little bit more efficiently. They only need to furnish one living room and one kitchen and one foyer, et cetera, et cetera, et cetera. But there are other household and budgeting items too. 2 incomes typically boosts the approval odds of receiving a loan and what the limit on that loan can be. Having a better debt-to-income ratio as a couple for joint applications certainly helps too. Spouses and families typically have cheaper per-person health insurance costs. And in some cases, including what my wife and I do in our house, actually, personally. So I'll just say, we coordinate our benefits across 2 plans. In our personal case, the cheapest thing is actually for my wife. My wife doesn't take on her health insurance at all. Her employer actually offers her a small stipend, but then they have to go off and kind of buy their own health insurance on the open market using that stipend, and she chooses not to do that. Instead, using my company insurance, we're on a partner plan, like a husband plus wife plan. We could be on a family plan to include our child, but again, just looking at the numbers and trying to understand the best fit. In New York, there's a system called Child Health Plus, which if you're not familiar with Child Health Plus is a terrific program any way you cut the cake. Because on one hand, it offers extremely comprehensive health insurance to people, I think it's under the age of 19, and it's means tested. So under a certain income threshold, Child Health Plus is very, very affordable. And it's, a certain multiple of the poverty line. But even at where my wife and I are, where our family are, we don't qualify for the means tested portion at all. We pay full price for Child Health Plus. But still, you compare full price of Child Health Plus, it's still a terrific deal when compared to private health insurance. And it provides just such a wide array of coverage for our daughter. So anyway, when you're married and you have two potential health insurance plans to choose from, you can make a really optimal choice for your family. But the benefits extend from there. I think another big marital benefit has to do with taxes. Usually, married filing jointly on your taxes results in a lower effective tax rate due to wider tax brackets than filing single. In almost all scenarios, a married couple will pay less tax by filing jointly. And then married couples also have 2 times the standard deduction, which on its face probably shouldn't matter because 2 individuals would each be able to claim their personal standard deduction otherwise. But this matters though when a married couple is going through some sort of outlier working arrangement. Perhaps one spouse is taking time off to raise the kids. Perhaps one spouse is retired early, something I know happens in this community that we talk about when one person chooses to retire early. They aren't collecting any income. Well, as a married couple, they still get 2 times the standard deduction. If they were filing singly, well, you don't really get to utilize your standard deduction if you're not earning income. But in these corner cases, you do, and that's pretty nice. We can also look at retirement and investment benefits. Spousal IRA contributions, for example. A non-working spouse can contribute to a traditional or Roth IRA using their working spouse's income. Now, this one isn't that big of a deal, but it's a small bonus. It's a nice bonus that some married couples do get the benefit from. And then there's Social Security, right? Spousal and survivor benefits. This one is huge. We covered it deeply in episode 86. It was our second AMA episode. Survivor benefits are pretty easy to explain. If your spouse dies and their Social Security benefit is higher than yours, then you get to start collecting their benefit amount. Spousal benefits are somewhat similar, but they kick in during life. They typically occur when one spouse had a very full and high-earning working career, while the other spouse had limited or no working history. The non-working spouse can receive up to 50% of the working spouse's Social Security benefit as the spousal benefit. So yes, just to be clear, even if someone says, well, listen, I've worked my entire life, but my husband, he was the stay-at-home dad, right? I was the partner in the law firm. My husband was a stay-at-home dad. He basically stayed at home for 20 years with the kids, doesn't have much of a working history. And on his own, he's only going to be able to collect $500 in Social Security per month, where I, the longtime law partner, I'm going to get to collect $4,000 a month in Social Security. Well, actually, your husband is going to be able to collect half of what you collect. So once you start collecting your $4,000 a month, your husband's going to step into the $2,000 a month spousal benefit. Pretty cool. Moving on, estate planning is easier too. At least there are things you can do kind of easy estate planning as a couple. Something like you can label your accounts joint tenancy with rights of survivorship, and that can kind of smooth the asset transfer or TOD, transfer on death. You should get a will anyways, don't get me wrong, but many localities default their spouses as the heir, which reduces any possible probate complications. And then there's some longer term, probably more intangible benefits too to being married. Maybe having a full-time accountability partner in spending and saving who will actually get upset at you if you spend $2,000 or even more on camping gear or Christmas decorations. That's probably a good thing for your personal finances. It's not a hard and fast rule, but married couples are probably more likely to do financial planning, to save for retirement, to use outside resources to secure a better long-term financial future because they're bouncing ideas off each other. Okay, you feel free to argue on that one. I could suppose someone could look at me and say, Jesse, I know some couples who refuse to talk to each other about money because it just leads to arguments. So maybe it'll be a bad thing. I'm willing to be flexible there. But then all of this compounds. I think all of these benefits that we just talked about, even if only half of them are true for a particular couple, all those benefits will compound with each other. Married couples are statistically able to accumulate more wealth due to the way that all these factors compound over time. Now, I do think there are some pretty big financial benefits to being single, or at least, tangentially financial benefits. First and foremost, I think of sole control. It's hard to have a disagreement over saving and spending when you're the only one in control with, full autonomy over your income and expenses. If you happen to be a child-free single person, you're avoiding the major costs tied to parenting, which I think now are estimated at $300,000 to $325,000 per child over 18 years. Also, if you're single, there's no keeping up with your partner's habits or expectations or the expectations of their family or friends, which is huge. That's a big one. There's a career and earning flexibility too. As a single person, you can more easily choose to relocate for a higher paying job or just relocate because you feel like it. There's no need to compromise on career or geography because of what your partner wants. On the housing front, being single does have its perks. Mainly, I think of the freedom to minimalize without needing a partner's consent. You can downsize or co-house or house hack. You can live in a lower cost of living area without needing to consider your partner's preferences. Retirement planning, there are probably some benefits to being single. For example, it's easier for a single person to qualify for Roth IRA contributions, I know that one, than for a married couple. It's also easier, usually, to plan for retirement using one person's life expectancy, using one person's RMD schedule, one person's Social Security timeline, et cetera, et cetera. It's just easier to plan for retirement solo. There's no risk of divorce, last I checked, if you're a single person. And that is a pretty big one. Divorce is a very expensive struggle that many people go through. So in short, there's lower complexity, there's more control, and there's more flexibility to being single. All else being equal, I just think that the sheer numbers, there are more benefits to being married. There are pros and cons of each. And Bridget, I forget exactly, I think in your question, you let me know some of your thoughts on it. Point being is try to make the most of your situation. And I think in either case, there are some little things that we can do to try to maximize our marital or relationship status for our personal finances. Thanks, Bridget. Here's a quick ad, and then we'll get back to the show. I still remember it was 2019, and a guy from Fidelity came in to speak to my then employer about personal finance in general and about our 401k plan in particular. There were 60 or so of us who attended, mostly 50 plus years old, clearly with retirement on their minds. And nothing against this individual from Fidelity, but unfortunately, the guy just didn't really know what he was talking about. It ended up being a major disappointment. And a bunch of my colleagues afterwards said, in short, man, we're really thirsty for good financial retirement information. Where do we go find it? Now, does that sound true, listeners, for you and your colleagues? Last year, either in person or via Zoom, I spoke to about 800 employees at 11 different organizations, sometimes about personal finance in general, sometimes about specifics of their retirement plans, sometimes about the nitty-gritty details of Social Security and withdrawal planning and retirement math. The point being, if you're interested in inviting me to come talk money to you, to your colleagues, where you work, that is absolutely something I'm interested in talking to you about. Simply drop me an email to jesse@bestinterest.blog and let's start a conversation. Question 3 is from Al from Philadelphia. Al is in a great, solid financial position. He and his wife are about 50 years old each, with very stable, rewarding, and lucrative jobs. They're experts in their field. They make over $1 million a year, which on its surface might not be something that all of us can relate with, but the problem facing Al and his financial plan is something all of us can relate to. In short, Al's got a bunch of money saved for retirement. Almost all of it is in traditional pre-tax accounts, and they're contributing close to $200,000 a year into their retirement accounts. As of now, it's all pre-tax, and they plan on working till they're 70 years old. But Al's question is about the Roth 403b option in his life. He's got a tremendous, significant amount of money saved in traditional retirement accounts. It's only going to grow more and more over the next 20 years. And then there's this shadow of large, looming, required minimum distributions in Al's future retirement. So should Al start worrying about those large future RMDs and thus start contributing more Roth dollars starting today? That is the question. And really, it's a Roth versus traditional question. Again, for those newer to the podcast or to the world of retirement planning, RMDs are required minimum distributions. Traditional retirement assets, which are tax deferred, right? We've never paid a penny of income tax on that money. The IRS wants its money eventually. Just a couple minutes ago in an earlier question, I think it was Cole's, we talked about, well, if you die with these assets and you leave them to your kids will eventually have to pay the income tax on that money. But even if you live, eventually you will get hit with what are called RMDs. The IRS wants its tax. They have these required minimum distributions, which say when you hit a certain age, and for today's retirees, it's age 73 or 75. When you hit that age, you will be forced to take a distribution out of your traditional retirement account, and thus you will be forced to pay income tax on it. And what Al is pointing out is that for him and for his wife and for their family, that RMD is going to be quite large. They have $6.5 million in retirement accounts today, with another 20 years before they want to retire. They could easily, realistically, have $20 million in their traditional retirement accounts by the time they retire. And that would result in an RMD on the order of $750,000 to $1 million per year. And they're only going to go up from there. Those RMDs will place Al and his family in the very highest tax brackets, almost assuredly. I can't guarantee it, but almost assuredly. So Al is asking, why not just put money into Roth accounts today, pay some tax today, but then never have to worry about RMDs again? RMDs apply to traditional investing accounts, retirement accounts. They don't apply to Roth accounts. So here are my thoughts for Al. If we knew with certainty what the future state and federal tax rates would be, then this exercise answering Al's question would be easy. It would be child's play. Well, for financial planners, it would be child's play. But unfortunately, we don't know what those tax rates in the future will be. So the way I see it is there are two ways then to solve Al's problem. The first one that I'll walk through now is probably my preferred way of solving the problem, and that's to admit that I don't know what the future rates will be, but I assume they will resemble today's rates. I don't know exactly, but I assume they'll resemble today's rates. And if that's the case, then Al should make as many traditional pre-tax contributions as he possibly can right now. Because even if he does, and he ends up with really high RMDs in the future, it'll just end up being an even trade, right? He'll save approximately 43 cents on the dollar today, allowing him to avoid taxes today, grows the money tax-free in the qualified accounts, and then later he will pay 43 cents on the dollar when he withdraws that money. But if there happens to be even a sliver of tax planning opportunity sometime in the future for Al in his future financial plan, then what'll happen is he'll be saving 43 cents on the dollar today to pay much less than 43 cents on the dollar later. That's good. That's what we want. That's that tax arbitrage that we're going for. So by saving the maximum today in his current highest tax bracket that he's in, he at least opens up a door for potential tax arbitrage later. Now, in Al's case, those arbitrage years, it might only be from the time he retires at 70, which is what he said, until RMDs start. If the tax law doesn't change for Al, his RMDs will start at 75. So he might only have 5 years to do this tax arbitrage. If his wife retires, she's a little bit younger, according to Al's email. Maybe she'll have a couple extra years until her RMD age, a couple extra years for tax arbitrage. But here's the thing. Al and his wife might change their minds between now and age 70. It's right. For them, it's 20 years away. I mean, what if they look at each other at age 64 and they're like, you know what? We've got $18 million right now. We're burned out of work. I know we told Jesse 14 years ago we were going to retire at 70, but we reserve the right to change our mind and we're going to go retire. Let's go enjoy life. Well, at that point, they'll be in their mid-60s and they'll have 10 plus years for RMDs. During those 10 years, they are going to crush Roth conversions, paying only, I say only, but paying only 22 or 24 or 32 cents on the dollar at the federal level, thus minimizing much of their future RMD tax liability. So the point being is that because they find themselves in the highest tax bracket today, my first instinct is to say, maximize your traditional contributions today. Save as many tax dollars as you can today, because you never know how the future will unfold. You never know where there'll be those little slivers of tax planning opportunity, and odds are they will save money later. They will find ways to arbitrage their taxes later, only if they give them the opportunity starting today, which is why you max out your traditional account. But I will admit there is a second way to potentially solve this problem, which, listen, came from my brain. I get it. I think it makes sense. And the second way is to say that, some pretty smart people, they look at our current tax landscape here in the US, which is kind of historically low tax rates as compared to history, low income tax rates, low capital gains tax rates. They also see our national debt, which we talked about, I think, in episode 102, which is too high. Even though, as I discussed in episode 102, it's not purely bad, but listen, the national debt is probably too high. And those smart people say, well, if I'm a betting person, tax rates are going to go up in the future. Tax rates are low, debts are high. We need to balance that scale. We are going to raise tax rates to start paying down the debt. And if you believe that, and if you're one of those people, listen, I totally get it. But for that reason, those people would say, you want to lock in your Roth dollars today, right? You want to pay taxes now at today's quote unquote low rates because you'd only owe more in the future. It's a totally fair argument. What happens if today's tax brackets, which in order are 10, 12, 22, 24, 32, 35, and 37%, what if they expand out to something like 15, 20, 25, 30, 40, 50, 60%? What happens if the middle quote unquote brackets go from 22 and 24 to 30 and 40? What happens if the highest tax brackets go from 37% up to 60%? Would you want to save 37% today in order to pay 50 or 60% on your RMDs later? No way. You wouldn't want to do that. The problem, of course, is that we can't be certain about those future tax brackets. It's all a guess. But Al, or any of you listening, if that prospect that I just outlined, if that scares you a little bit, or if you think there's some validity or some truth in that, or if that's a future that you would kind of kick yourself knowing that part of your brain thought that was a possibility and you ignored that possibility. If that's you, then I recommend you split the difference and you hedge your bet and you admit that no matter what the future throws at you, you'll be half right and half wrong. In other words, what I'm really saying is split your annual savings roughly 50% between traditional accounts and Roth accounts. So yes, what that means basically is no matter what the future tax regime throws at you, half your money will be a tax arbitrage and the other will be a tax loss. Or maybe 100% of your dollars will be completely neutral. In any future year where your traditional dollars end up being tax arbitrage, that means that your Roth dollars were actually a losing arbitrage and vice versa. So yes, these two answers, as I've just outlined in this question, it's a bit talking out of both sides of my mouth. Do I want to pretend like I know what the tax future will be? Or do I want to admit that I have no idea what the tax future will be? But that happens a lot in the world. It happens a lot in the world of financial planning simply because we are not fortune tellers. We do not know the future. But still, for Al, for any of you listening, I think it's really good food for thought for you and your families. And to preempt some questions for you listeners, the Roth versus traditional math, it's a constant topic, but the math is clear. It is all about tax rates and tax arbitrage. You take today's tax rates and you compare them to the tax rates in the future, and not just the governmental tax rates to be fair, but more importantly, your specific tax rates based on how you expect your income will change over time. Occasionally, you will hear someone talking about Roth dollars and they'll say something like, well, would you rather sacrifice 20% of an acorn or 20% of the whole oak tree? And the premise is that by paying 20% of the acorn, it must be better because an acorn is smaller and you'd rather pay a smaller amount with fewer tax dollars. It's this convoluted metaphor that basically says Roth is better. With Roth contributions, you're paying the tax now and then letting it grow tax-free. And with the acorn metaphor, you'd rather quote unquote pay 20% of the acorn, the tax now, and then let the oak tree grow. You pay a tax today on a smaller amount and then you let it grow. But the acorn and oak metaphor, it's kind of stupid, and it never seems to explain the fact that if you lopped off 20% of an acorn, then your subsequent oak tree would grow up 20% smaller. In fact, it would be the same exact size as the full-grown oak tree that you had just lopped 20% off at the end of its life. Like, the math is crystal clear. I don't know how else to say it. Just pull out a spreadsheet, just pull out a pencil and paper and start with $1,000, have it grow by 10% per year, lop off 20% at the very end of the analysis, and now start with the same $1,000, lop off 20% down to $800, and go through the same investment growth, you're going to end up with the same amount of money. So don't worry about the acorn or the oak tree. Simply understand the tax rates that you're paying today against the potential tax rates you'll be paying in the future, and then assign your traditional and Roth dollars accordingly. Okay, on to question 4 from Corey. So Corey wrote in and said, Jesse, I've gotten very serious about personal finance recently and consumed a large amount of personal finance content over the last 18 months. But something I've noticed to be lacking is how to plan and account for healthcare costs during all phases of your retirement planning. I think most people would agree that healthcare represents a huge aspect of an individual's or family's financial picture. And I think the argument could be made that on average, it is a poorly understood topic by the general public. Corey, I think you're making a great point. And I'm happy to admit that on average, or maybe, when I compare myself to maybe some of the other topics, some of the other knowledge areas that I'm familiar with, that I know my fair share about portfolio this and account type that and tax planning, saving on taxes, when to claim Social Security. I've got my facts down in those areas. But when it comes to Medicaid or IRMA or the ACA or some of those ideas, I can poke my way around. I can kind of talk my way around those topics, but not nearly to the same depth as some of the other retirement topics. So your question kind of caused me to dig a little deeper into this question of healthcare, or at least deeper than I had before. So I'm going to present to you my best understanding of healthcare costs during all phases of your retirement planning. So first, healthcare costs while working. Typically, while working, we have an employer-sponsored group plan. It might be a high deductible plan or an HDHP, which qualifies us to then open a health savings account or HSA. It might be worth defining some terms here like premiums or deductibles or copays or out-of-pocket maximums, right? These are all terms that we hear thrown about the healthcare world. Premiums. Think of premiums as your monthly membership fee for having health insurance. You pay your premium every month, whether you go to the doctor or not. It's the cost of, staying in the club so your insurance is active and ready to use when you need it. Deductible is how much you have to pay out of pocket each year before your insurance kicks in and starts helping. So for example, if you have a $2,000 deductible, it means that the first $2,000 of medical bills on that insurance plan, you pay yourself. And after that $2,000 deductible is reached, then your insurance starts to chip in. A copay is a fixed amount that you pay when you receive certain services. So for example, your insurance plan might have a $30 copay every time you visit your primary doctor, or a $10 copay for a prescription. So that means, and usually for what it's worth, copays kick in even before you've met your deductible. So, a doctor's appointment might be $300, but if your copay is $30, it means you pay the first $30. And then depending on if you reach your deductible or not, the rest might be covered. And then most plans do have an out-of-pocket maximum, which, as the name implies, it's a ceiling, the most that you'll have to spend in a given year on covered healthcare. Once you hit that number, insurance then pays 100% of covered expenses for the rest of the year. It includes what you pay towards deductibles and copays and coinsurance if your plan has that too. An interesting example would be back in 2024, when thankfully going into 2024, my wife and I knew that my wife was pregnant, and we knew that she was going to be giving birth to a baby around June of 2024. And so we were able to look at our options going into 2024 and understand, okay, the cost of giving birth at the University of Rochester Medical System is X. And therefore, will we hit our out-of-pocket maximum on our healthcare plan? We did. And anyway, it just allowed us to compare and contrast different plans and to plan ahead and to figure out how much giving birth to a baby would cost, with all the prenatal costs associated with it, some of the postnatal costs associated with it. Anyway, it's important to understand these different terms, because when the real world comes calling, it matters, right? It matters in our healthcare, it matters in our budget. The HSA account that I referenced earlier, health savings account, if you haven't heard of it, it is an amazing account with a so-called triple tax advantage, because you get to invest tax-deferred dollars at the front end. So the money that goes in is tax-deferred. You can then invest the money in the HSA, in mutual funds and the like, index funds. It'll grow tax-free, so that's the second tax benefit. And then when you spend that money on healthcare costs, on qualified healthcare costs, the withdrawals are tax-free too. So that's the third tax benefit. So a really cool account. And for what it's worth, if you don't end up using the money on healthcare costs, once you turn, I think it's 65, once you turn 65, you can essentially use an HSA account as if it were a traditional IRA. So you will have to pay income tax on your withdrawals if you're just using the withdrawals to fund retirement instead of funding healthcare costs. But you've gotten the tax-deferred contributions and the tax-free growth the whole time. So it's a really nice account. And then if you're not familiar with this loophole on HSAs, it probably is worth me reiterating it here, which is, if you want to, you can use your HSA kind of on an annual basis to help pay your healthcare costs, right? You put the tax-deferred money, maybe you choose to invest it, maybe not. And then when your son Bobby has to go to a doctor's appointment, it's $250. You just put down your HSA card, you pay the $250 that way. And essentially what you've done there is you've saved yourself probably 20 or 25 cents on the dollar in taxes. So you get this nice little discount for using your HSA. But the loophole, and the really interesting and cool and probably better way of using your HSA account, is to instead say, for Bobby's doctor's appointment, what did I say it was, $250? To say, I'm actually going to pay for this doctor's appointment out of pocket. I'm going to write a check. I'm just going to put down my credit card. I'm going to pay using after-tax dollars out of my normal bank account. Then I'm going to keep a receipt, and I'm going to keep that receipt for a really long time, and I'm going to keep really good records. I'm going to let my HSA continue to grow. I'm not going to spend my HSA dollars this year for Bobby's medical expenses. Instead, I'm going to let the HSA continue to grow because it's got the tax-deferred growth. And those tax-deferred dollars are kind of precious in our financial plan, right? Any qualified dollar has this little bit of a precious aspect to it because of the tax-free growth and because of the tax deferral on the front end or the lack of taxes on the back end, whatever it may be. So you let your HSA grow for some indeterminate amount of time, and it might be decades in the future where you say, you know what, I'm going to now start to benefit from these HSA dollars. And I'm going to go back in time to 2025. I'm going to pull out that receipt, including the $250 receipt for Bobby's appointment in May of 2025. And here in the future, decades in the future, in 2045, now I'm going to reimburse myself for that 2025 expense using my HSA dollars. The nice thing is, instead of doing the reimbursement in 2025 itself, where you really didn't get any benefit of compound growth in your HSA, you've now let your HSA compound for, in my example, decades. and you've really benefited from those qualified precious dollars compounding in a tax-deferred or a tax-free way. And only after that compounding has taken place do you choose to utilize the dollars and reimburse yourself. If you actually throw that scenario into a spreadsheet and see the kind of value that you accrue, it's huge. It's really cool. And all else being equal, you can afford to pay for this year's medical expenses out of pocket instead of using your HSA. In the long run, you'll be better off for it. So anyway, that's pretty cool. Well, back to Corey's question now. When we're talking about work-related healthcare or, how we have healthcare during our working years, if you do leave your job for any reason, including to retire early, it might be worth diving into what's called COBRA coverage. See, I didn't know this before putting this recording together. COBRA apparently stands for the Consolidated Omnibus Budget Reconciliation Act. Not that anyone cares. But anyway, when you hear COBRA, what you should think of it is it's a federal law that gives you the right to keep your employer-sponsored health insurance for a limited time after you lose your job or after you experience another qualifying event. So you can use COBRA if you lose your health insurance because of quitting, if you get laid off, unless it's for gross misconduct, apparently, if you reduce your work hours and that kind of eliminates your access to healthcare, if divorce or legal separation means you can no longer use your spouse's healthcare, or if an employee dies, let's say I die and my family's on my healthcare through work. Well, my family still, through the COBRA Act, my family still has access to my healthcare coverage through work. Usually, it's 18 months is the time period that COBRA can last for if you've lost your job or had your hours reduced. It's 36 months for events like divorce or death. But the catch with COBRA, if you didn't know this, is it's very expensive. When you're employed, your employer often pays a big chunk of your monthly premium on your health insurance. But with COBRA, you pay the full premium yourself plus a 2% administrative fee. So if your employer was paying $1,000 a month and you were only paying $200 a month, under COBRA, you now pay the whole $1,200 a month, right? So the idea is that you still have access to the plan if you want it. You can still maintain access to your same doctors, your same providers, the same hospital system if you want it. It's not like you get cut off completely from insurance. COBRA gives you 18 to 36 months to figure out what's next, but it is pretty expensive along the way. That's really the benefit of COBRA. And for some early retirees, it might make sense for them to at least look into COBRA as the short-term stopgap between the day they retire and whatever's next. But speaking of retirees, let's actually dive into healthcare costs as an early retiree. What if you reach FI, financial independence, you want to retire at age 45 or 50? You have no more work-sponsored plan, but you still have decades before age 65, which is when Medicare kicks in, and we will dive into Medicare in a little bit. The answer for almost all early retirees is to go shopping on the ACA exchanges. That's the Affordable Care Act or Obamacare, right? The ACA provides healthcare for all. Your ACA costs or premiums will be based on the following. First, your age. Younger is better than older, as to be expected with most health insurance. ACA costs will be determined based on where you live due to local medical costs and competition amongst private insurers. ACA costs will be determined based on tobacco use. Again, I think it's understandable how tobacco use can affect health insurance costs. And then the last one, which is it's probably the most important one for this conversation, or it's most, apropos of this conversation, is household size and income. It's huge, especially from a financial planning point of view. There's something they call it the premium subsidy, also called the ACA tax credit. The lower your income and the bigger your family, the more help you will get paying your ACA premiums. And this goes back, and when I think of this, it goes back to the puzzle piece metaphor or the spider web analogy or metaphor of financial planning, that all these different concepts, they fit together and they interact. They fit together like puzzle pieces, or they interact like a spider web, and they can compound in beneficial ways or they can compound in detrimental ways. And so to get cheap or even free ACA healthcare in early retirement, you can do that by keeping your income sufficiently low. You won't be working and collecting W-2 or 1099 income anymore, so that'll be easy. You might want to do some Roth conversions, though, in early retirement, or you might want to do some capital gains planning in the 0% gains bracket, or maybe you choose to utilize 72T, substantially equal periodic payments from your traditional accounts. That way you can access your traditional accounts before age 59 and a half. These are all tools that early retirees might choose to do. The problem, though, is that all of those smart things might negatively affect your healthcare costs, right? By increasing your income, you're no longer going to get access to cheaper ACA credits. So how do you optimize that problem? Well, that's a fun question, or at least I think it's a fun question. That's the kind of question I get to answer at work, right? That's the heart of financial planning. Now, there's a second interesting conversation here, but I'll save that for the show notes. I call it benefits hacking. I wrote an article about it a couple months ago. The idea is that a lot of public benefits are based on income or net worth, or sometimes both. ACA is based on income. So someone could retire early with millions and millions of dollars in net worth, but almost no income, and then they get free healthcare. Now, is that a genius move? Is that an immoral move? Is it somewhere in between? Do we hate the player? Do we hate the game? So anyway, I'll throw an article in the show notes that dives deep on that topic. But anyway, I do want to dive into an example of ACA costs. But still, I think, we can do that while also fast forwarding to healthcare costs in quote unquote the gap to Medicare. So really here, what I'm thinking about is someone who's 58 or maybe they're 62. They've got a pretty normal age for a retiree, but they still are too young for Medicare. And they want to retire from their full-time job. They no longer get a work-sponsored plan. The answer here is still going to be ACA. But it's important to realize that ACA premiums do rise pretty sharply with age. The costs can pretty easily exceed $1,000 per person per month without subsidies. So for, a married couple who's retiring, their cost of ACA without subsidies could easily exceed $2,000 a month for a couple, for two people. And the ACA subsidies, they change annually, both because your age is changing, right? You're getting older, but also due to changes, refinements in the ACA cost structure itself. So if you're worried about how to plan for your personal ACA costs, look no further. There's some terrific calculators out there. One's on healthcare.gov, like the government website. Another really good one is at kff.org. We will throw that link into the show notes. KFF is an independent health policy think tank. So I ran a simple test in the KFF calculator looking at someone here in my state of New York. I'm going to say they retired early at age 50, and they decided to realize $80,000 in income. So intentionally, they realized $80,000 in income between some of the smart planning tools that I mentioned before, Roth conversions and realizing capital gains in the 0% tax bracket. They have a family of 4, but only the parents will be on this plan. It's my hypothetical. The kids, I'll mention, will be on the New York Child Health Plus plan. If you're a New York resident and you're not aware of New York Child Plus, it's definitely worth checking out. Happy to tell you why my family is using it. And if you're not in New York, you might want to see if your state has a similar program to New York Child Health Plus. Anyway, back to the answer. I've shared with you the details about this family, right? Age 50, healthcare for the 2 adults, and $80,000 in income. With those facts, I'll say, this family will then have 80% of their monthly ACA costs covered by the premium tax credit, leaving a monthly cost of them of $284. Now, I don't know about you listeners, but that number is pretty low, surprisingly low to me. So this early retired couple, they need to budget about $300 a month for their healthcare costs for 2 adults. If your income is too low, you actually won't qualify for ACA anymore, because you will have such low income that you'll qualify for Medicaid instead. Now, while Medicaid is free, there are some downsides. Mainly, Medicaid providers can be limited in some areas. Timely access can be a big issue. So I know of a lot of people in the financial independence community or early retirees who are very big proponents and really bigger proponents of the low premium ACA plan rather than the free Medicaid plan, because the ACA plan gives them more access to more providers, more flexibility. So again, in summary, whether you are a very early retiree like age 40 or 45, or simply you're a retiree at 58 or 60 or 62, and it's before your Medicare age of 65, the ACA is probably going to be your way forward. And as long as you kind of maintain some controls over your income, you're probably going to get some pretty nice premium tax credits, and your actual ACA cost will be reasonable. Not free, but reasonable. And last, let's talk about healthcare cost once Medicare kicks in, once we turn 65. Medicare could probably be, and maybe will be actually, an episode entirely onto itself. I might have a Medicare expert on at some point to really dive deep on Medicare, because it's confusing. I've had to learn and relearn about Medicare multiple times. I find it to be a pretty confusing topic. The first reason why is that there are multiple parts of Medicare, and not every person needs or wants or pursues all the parts of Medicare. So Part A, Medicare Part A, covers hospital care and skilled nursing and hospice, home health. Most people get Part A for free as long as they or a spouse paid Medicare taxes for at least 10 years. Most of us have qualified for that. Most of us get Part A completely for free. Now, Part B, Medicare Part B, is medical insurance. And this is the big part that most people are aware of. When most people say Medicare, or at least when they think of what Medicare does in their lives as a retiree, really what they're thinking of is Part B. It covers doctor's visits, outpatient care, preventative services, stuff like that. And Part B has a premium. It has a monthly premium, a monthly membership cost, which ends up, at least as of now, 2025, it's around $180 a month. However, that premium is subject to something called IRMA. We've talked about IRMA before on the blog and on the podcast, IRMAA. IRMA, to be blunt, is an extra tax, an extra Part B tax that high earners must pay. So IRMA has the possibility of increasing your monthly Medicare Part B payment from $180 per month to as much as $600 per month. Now, I don't want anyone to get too freaked out because in order for your IRMA to increase your total cost that high, I'll just run through some numbers. Your Part B premium is $185 a month. I think I said $180. It's actually $185. Now, if you as a couple earn above $266,000 a year, up to $334,000 a year. So again, as a couple in retirement, earning more than $250,000 a year, that's a lot of retirement income, your Part B premium, instead of being $185 a month, will approximately double, actually exactly double, to $370 a month. Okay, maybe that doesn't sound too fun, but it does mean that you're earning $250,000 a year in retirement. If you as a couple, again, are earning more than $386,000, but less than $750,000 per year in retirement, then your Part B premium balloons up to $592 a month. So again, $592 a month is more than triple the base premium for Medicare. It's a lot. It's a big increase. But I think I've maybe mentioned this on the podcast before, where the people who are subject to the biggest IRMA taxes are also the people who can absorb it the best. I mean, granted, you're free to have your own opinion on taxes and progressive and regressive taxes and the way the tax system works. But the last IRMA threshold, if you're making more as a couple, more than $750,000 per year in retirement, then your Part B premium is going to be $600 a month. So you multiply that by 12, right? You end up getting $7,500, $8,000 a year for Medicare. So if you're earning $750,000 or more, you'll have to spend $8,000 or about 1% of that on your Medicare premiums. To me, it's not the biggest deal in the world, but feel free to argue with me there. Anyway, so that's Part B, and that's IRMA. Part C of Medicare is often called Medicare Advantage. And these are private insurance plans that are meant to replace Medicare Parts A and B. And they often include added benefits on top of Medicare A and B, like dental or vision or prescriptions or fitness perks, et cetera, et cetera, et cetera. So you would still pay your Part B premium here, but then you'd get all of your services through a private plan. And then Part D, Medicare Part D, is prescription drug coverage, usually costing around $30 to $50 a month. You need to enroll into Medicare. We all need to enroll into Medicare, and the window to do so starts 3 months before you turn 65. And you must enroll. A late enrollment, and I think you get 7 months to enroll, don't quote me on that, but a late enrollment leads to lifetime penalties for Part B and Part D, so you want to enroll. To make matters a little more confusing, there's also something called Medigap. It's a supplemental private policy meant to cover some of the gaps, as the name would imply, some of the gaps in Medicare, such as covering co-insurance charges in Medicare, often providing broader provider access. Especially, when you think of someone like a snowbird, I deal with snowbirds a lot, someone who spends their summers or the nice parts of the year here in upstate New York because they're probably an upstate New York native. But then in the winter and the kind of nasty parts of the year up here, they go to Florida, snowbird. Something like Medigap can be really helpful where they can get their provider in Florida when they're in Florida. They have their provider in New York when they're here. So some retirees opt to get Part A for free, like we already discussed. They pay their Part B premium plus IRMA for Part B. They then get a Medigap plan to do things like cover coinsurance and deductibles and to fill in those gaps. And then they pay for Part D for prescriptions. But other retirees, they opt for the Medicare Advantage plan, which was Part C, because that includes Part A and Part B, and usually includes Part D as well. It includes some sort of prescription coverage. The median retiree spends about $5,000 per year, which includes both the Medicare premiums and any out-of-pocket costs. So the median retiree spends about $5,000 per year on all these costs. I do think there's one more retiree topic specific to retirees worth covering here, which is the question of nursing homes, extended care, and other options that we've all probably heard of and we've all heard can be very expensive. The generic term that I'll use is long-term care, or LTC. LTC, long-term care, refers to non-medical help with everyday activities like bathing, dressing, toileting, transferring in and out of bed or a chair, eating, and continence. And when someone needs help with 2 or more of those activities of daily living, they're typically eligible for LTC services. Home care is services brought into an individual's home, like personal aides or visiting nurses or physical therapy. It's the most flexible and the least disruptive of LTC care. It's not typically covered by Medicare unless it's short-term and medically necessary. Next on the list are assisted living facilities. So assisted living facilities usually help people who have those ADL needs, activities of daily living, in a residential setting. The residents in an assisted living facility, they still maintain pretty good independence. There's no around-the-clock nursing, and this is not covered by Medicare. Next is memory care, and that's specialized assisted living for individuals with dementia or Alzheimer's. There's a higher cost due to supervision and safety. And then last, nursing homes or skilled nursing facilities. Usually there's 24/7 care, including medical supervision. It's for individuals with serious health needs or a total loss of independence. Medicare pays short-term, usually up to 100 days if qualified. And then after that, the individual or the family has to pay out of pocket or rely on Medicaid. Now, the cost of these things. Now, granted, I will say these are 2024 national averages, and these costs can vary wildly by location. And I'll say personally, these costs that I'm about to list out to you, they seem a little bit low to me based on my understanding of the costs here in Western New York. Maybe where you are, these costs are actually higher than what you're expecting. For a home health aide, and that's about 40 hours a week of home health services, the monthly cost is about $5,500 a month. For an assisted living facility, about $5,000 a month. For a memory care unit, about $8,000 per month. And for a private nursing home room, about $10,000 per month. Again, I actually think those costs are a little bit low, but I found a source that cited those as 2024 national averages. So, Corey and any other listeners with similar questions, there's certainly a lot to learn when it comes to how we're going to pay for healthcare throughout our lives, but the information is certainly out there, especially when it comes to how these medical costs might impact our cash flow planning and our overall financial plan. So I hope this answer helped you out. Here's a quick ad, and then we'll get back to the show. Serious question. Why do podcasters constantly ask for ratings and reviews? Yes, they do help highlight our shows to new listeners. They help strangers find us on Apple Podcasts and Spotify. It's totally true and a good reason to ask for ratings and reviews. But I have something more important, at least more important to me. I want to know if you like this stuff. I want to know if you like my podcast episodes, my monologues, my guests, the information I share with you and the stories I tell. I want to improve and make your listening more enjoyable in the process. So yeah, I would love to read your reviews. And sure, if you throw a rating in there too, that's great. If you like what I'm doing, please share it with me. It's such a great feeling to read your feedback. I'd love to read your review or see a rating on Apple Podcasts or Spotify. Thank you. And last, question 5, the last question of today's AMA episode, is another twofer. It's really 2 questions in one from Brian and Dan. Brian asked for my general thoughts on everything that's tariffy and economic-y going on here in 2025 so far. And then Dan asked for my thoughts on the best investment strategy during a recession. Now, granted, I'll say I'm recording this on May 14th. I think this episode is going to come out in either late May or early June. And as of today, I'll actually pull it up right now. The S&P 500, okay, it's down a little bit today, just a tiny bit so far. But year to date, it's actually up year to date, right? We've recovered that much from the tariffy lows of April that we're actually up year to date. And when I compare to where we were in mid-February, which is the high so far this year, we're about 4% off the highs. So again, we'll see what happens over the next 3 or 4 weeks by the time this episode comes out, or we'll see what happens by the time you personally happen to be listening to this episode. But right now, we've been kind of climbing this wall of worry over the last couple weeks and quietly, or maybe not so quietly, recovering from the volatility that early in mid-April saw after the initial tariff announcements and then, retractions and et cetera, et cetera, et cetera. Brian, for a bigger take on tariffs, I'll point you back to the episode I released on April 14th, which is a deep dive into a lot of tariffy topics. But the short answer is this. As I speak these words, the balanced portfolios, the diversified portfolios that I manage for myself and that I manage for others are down maybe 1% since their highs in February. Again, the S&P is only off 4 or 5%. International stocks are up. Bonds are flat. So portfolios are only down 1% since their highs in February. They're actually up 3% on the year. They're up 4 to 5% from April 2nd, the day when President Trump officially announced his initial tariff plan. So despite all the questions and all the chaos, most portfolios are actually doing just fine, which is, again, it's kind of crazy in and of itself. And it just goes to show that often the public discourse and the public dialogue and the headlines and the concerns that are flooding our minds don't always actually match what's going on in our portfolios. And it's really important to remember that. Now, granted, will it stay this way for the rest of the year, let alone for the next, 3 weeks before this episode actually releases? I don't know. And also, it's like, do I think it's actually a good lesson that all of this economic uncertainty resulted in basically a 6-week period that was peak to trough and then back to peak? I don't think so. I don't think that's actually a good lesson. In my opinion, it's too short of a recovery period. And it's not that I encourage, self-flagellation and pain. It's not that I want people to have to go through really hard times. I don't. But I do think as long-term investors, we need to live through some periods of real investing loss in order to understand what we've signed up for. And depending on who you ask, maybe 2022 was a pretty good year of investment loss. Those early months of COVID was a pretty distinct and sharp period of investment loss, even though it didn't last that long. All I know is that 6 weeks isn't that. Instead, I think it's easy to walk away from these past 6 weeks with maybe the wrong lesson, which is that not only do markets always recover, but they do so in, 2 months. I think that's probably a bad lesson and a bad takeaway, but hey, this is what the world has thrown at us. This is what history this is how it's played out this time. So anyway, I think it's worth pointing out that the market has always recovered so far. And as we've seen this year, many investors' nerves are really on a hair trigger, which is why markets can fall really quickly, but then also recover really quickly, and then certainly possibly can fall quickly again. And I think this is a great time to discuss what I call the casino analogy, or I wrote an article where an alien walks into a casino. So an alien walks into a casino. He's never been there before. That's the idea, I suppose. His first stop is the poker table, and he sees players being dealt cards. They're wagering chips. This dealer maintains the flow of play. Some players are winning, some are losing. The alien's kind of struggling with the rules. Then he ambles over to the blackjack table, right? So he sees similar things, similar players. There's a similar dealer, the same exact 52 cards, the same exact multicolored chips. And he's asking himself, how is this different than poker? I traveled 50,000 light years to see this. So the alien, understandably, is a bit confused. And I think if you put yourself in the alien's shoes and just think about how many unique games can be played with a deck of cards. So the International Playing Card Society estimates there are over 1,000 unique card games with the standard 52-card deck. And each game's strategy, of course, is dependent upon its specific rules and goals. Folding a set of kings or a pair of kings would be crazy in Texas Hold'em poker, but discarding 2 kings makes a lot of sense if you're playing gin rummy. So the same action can be genius or can be folly, depending on the context, depending on the game, depending on the rules. Most average investors bear some similarity to the alien. Wall Street happens to be their casino, where there are stocks and bonds and alternatives taking the place of cards and chips and dice. And the assets can be bundled together into mutual funds or into funds of funds, kind of like Russian nesting dolls. And then television experts are out there shouting about puts or calls or double levered fund this. Thousands of assets, thousands of strategies, and many different games, right? But most investors, they fail to ask themselves, what game am I playing? And why am I playing that game? Am I playing poker? Am I playing blackjack? Or am I playing one of 1,000 other variations? And what tactics or what assets make sense in my particular game? Am I in it for the long haul, or am I in it to make a quick buck? We kind of get caught up in some of the intoxicating vapors of Wall Street. And too many investors, we end up mimicking the games that we see other people playing, right? We pour money into popular investments, despite decades of research concluding that's actually probably precisely the wrong behavior to be following. The smartest strategy is always going to be a function of us and our life and our goals and our timelines, not necessarily a function of what the crowd is doing. And some investors, they go to extremes. They take on way too much risk, or they avoid risk altogether. They go all in, or maybe they play not at all. And how much risk ends up being right? Well, of course, it depends on the game that we're playing and the goals in our life. So why don't more investors understand this, right? Why don't more investors understand their smart strategy? Why don't they know their reason for investing in the first place? I think it's because there are no clean lines on Wall Street. In the casino, I think the lines are pretty clearly drawn. Poker is over here, blackjack is over there, the slots are in the corner, roulette is over here, et cetera, et cetera. They're similar games, sure, but they're clearly demarcated. There's no confusion about what game you're playing. But that's not the case on Wall Street. There are no clear lines. The market is wide open to any participant looking to make a deal. And we're all trading the same financial instruments on the same markets, all at the same time, right, concurrently. It's as if every game at the casino was played off of the same deck of cards or played off of the same pair of dice. It would be total confusion, total chaos. Imagine that, right, a table of poker players and a table of blackjack players trying to play their games while only looking at a single deck of cards. Well, Wall Street is exactly that chaos, right? We have one shared marketplace for both conservative retirees and for TikTok Robinhood gamblers alike. We're all playing together off the same deck of cards. Roughly 60 million shares of Apple trade every single day. Some are going into 401ks, some are going into index funds, but other shares of Apple are being wagered in risky options contracts. The same exact game pieces, but vastly different games. Half the market thinks that Apple's price is a smart price to be buying Apple today. The other half of the market thinks that it's actually a smart price to be selling Apple today. So again, the same exact players, but wildly different opinions. Some of us are in it for the long haul. Other people are making daily bets. So again, the same players, the same casino, but vastly different timelines. When my uncle Jim Cramer, no relation, but possibly an alien, when he's hollering on TV, is he shouting about your specific game that you're playing? Probably not, right? If you're listening to this podcast, I'd argue you are playing a much longer term game than what Uncle Jim Cramer is yelling about. But it's all too easy to feel some sort of familiarity with what he's saying. You know, you're saying to yourself, I own stocks. This is probably advice for me. And you might assume that Jim's advice does apply to you, but it doesn't, right? We have to know our game. We have to learn our personal strategy, and then we have to stick to it. We have to ignore the other people playing their games because most of them are probably aliens still struggling with the rules. So anyway, that's that article. And one of my takeaways from 2025 so far is remembering that analogy. Lots of investors playing lots of unique games, following their specific mandates, their specific timelines. Their actions are a function of their games. Not my game, though, and maybe not your game either. They might be panic selling, or maybe in April they were panic selling, and maybe now they're panic buying because they're playing a shorter term, higher risk game. And we're playing a long-term game. Don't let their actions pollute their way into your game. And then Dan asked about the best investments in a recession. So Dan, personally, I approach this investing problem by trying to understand someone's financial goals, the timelines of those goals, and then I recommend we use the best appropriate investment with a specific risk and reward profile based on those timelines. So goals first, and then timelines, and then how much risk and reward do we need to take and how much reward do we need to seek based on the timelines in question. When it comes to a recession specifically, I wonder to myself, how does a recession fit into those timelines? So depending on where you look, where you get your data from, there have been about a dozen recessions in the USA since World War II. Most of those have lasted less than a year, and all of them have lasted less than 2 years. Meanwhile, I only think of stocks as an example. For me, stocks are an appropriate investment over 10 plus year timelines. So right off the bat, if I'm worried about a recession this year, which might last into 2026 or maybe even into 2027, I am thinking on a different timeline than what my stocks are for, right? Instead, I'm thinking more on a bond and cash timeline over 1 to 2 years. So how do bonds, how do cash perform in a recession? Well, cash is cash. It maintains its nominal value, but it does lose purchasing power to inflation. There's not much we can do about that. Does inflation increase or decrease during a recession? In most cases, inflation goes down during a recession, which is actually a positive outcome, if you will, if we're looking specifically at the cash on our balance sheet. And then what about bonds? Well, bonds also lose purchasing power to inflation, not good. But recessions are almost always a reason for the Fed to lower interest rates. And when interest rates go down, the value of the bonds we currently own, the value goes up. So in that way, recessions are actually a good thing for bonds in our portfolio. As I mentioned in the tariff bonus episode that I referred to earlier, I think cheering for a recession is very dumb. It's a very dumb thing to be doing. But if all we're doing is hyper-focusing on the cash and bonds that we own, a recession actually isn't that bad. And if we're thinking about the stocks that we own, as I just alluded to, yeah, over the 1 to 2 years it'll take for a recession to play out, I don't think we should expect our stock portfolio to do well. But we're not owning stocks for 1 to 2 years. We're owning them for 10 plus years. And if you're there playing at home and you're thinking to myself, well, why don't I just sell my stocks now and I'll buy back once the recession is done? Like, duh, Jesse, isn't that the way to do it? There's some really interesting research data when it comes to getting the timing of a recession right. Again, this is a market timing question ultimately, right? And the simple fact is that the market, because it's filled with, the market is nothing more than the summation of all investors doing all their buys and all their sells. And these investors are trying to be pretty smart with their money. They're trying to peer through the fog of the future to see what the future will hold for them. Basically, they front run the end of the recession. That's the best way to put it. And on average, the market hits its bottom about 6 months before the recession hits its bottom, before the economic indicators hit their bottom. So if you're sitting there waiting for the economy to bottom out, if you're sitting there waiting for gross domestic product to turn around and start going positive again, odds are you missed the boat in the stock market by about 6 months. And odds are you missed the returns in the stock market by 20 to 25%. In other words, getting that timing right in order to time the recession right, it's really hard to do, as with all market timing, and I just don't think it's worth trying in the first place. I recently finished a book, though, Bill Bernstein's book called Deep Risk, and the book outlines, it's a really short book, and I will say it's pretty dense for being like a 50-page book. I'd say unless you are the most hardcore of investing nerds or even an investing professional, I'm not sure I'd recommend the book. But if you are a super hardcore investing nerd or you are an investment professional, by all means, go read Deep Risk by Bill Bernstein. The book outlines a framework for understanding the 4 most serious long-term threats to investors' wealth. These aren't short-term risks like market volatility. Bill Bernstein would say what we're going through right now, what we went through in 2022, what we went through in COVID, and even what we went through in the great financial crisis, he would call that a shallow risk because it only lasted a couple years, 3 years, 5 years, something like that. But instead, the long-term, the multi-decade risks, or potentially the permanent impairments of purchasing power, those are deep risks. So Bernstein breaks down these 4 different types of deep risk, and then he discusses the asset classes or the strategies that we can use to mitigate those risks. The first one is inflation risk, which I think is pretty straightforward to understand. And the way to defend against inflation risk is with stocks, especially global equities. With TIPS, those are Treasury inflation-protected securities, and with real assets like real estate, commodities, resources, that kind of thing. So inflation risk, fairly straightforward. Now, this next one, when it comes to recessions, this is kind of what we're talking about here, deflation risk. A broad decline in prices paired with falling wages, reduced business activity, higher debt burdens, right? Since debts are harder to repay in deflated dollars. An example of this would be the Great Depression, right? A normal run-of-the-mill recession is not going to be anything close to this. But if we have some sort of extended recession, okay, maybe we have some sort of deep deflation risk that's worth thinking about. And in that case, the best defense for deflation risk in our portfolio would be long-term treasury bonds, high-quality fixed income, and perhaps a modest allocation to gold. Now, Bernstein is cautious about the gold, and I am not exactly enthusiastic myself. I'm open to it, but not enthusiastic about it. But one thing that is interesting is that the defense against inflation risk and the defense against deflation risk, as we would expect, they're kind of polar opposites, right? If you're worried about inflation, the last thing you want to own are long-term bonds. But if you're worried about deflation, then yeah, you want to own long-term treasury bonds. They tend to gain value in deflationary environments. The third risk is confiscation risk, which is the risk of the government seizing or destroying wealth via, nationalization or punitive taxes or outright expropriation. So think of like Russia, 1917, when the communists came in and took over, or Argentina and Venezuela in more modern times. The defense here is international diversification, and that's holding assets literally outside your home country. It's not enough just to own, a domestic mutual fund that happens to house international assets, but actually holding those assets outside your home country, owning foreign stocks and foreign funds to protect against domestic policy risk mainly. And then, global custodianship in extreme cases like an offshore or foreign bank account. I will say the confiscation risk is, I think, the hardest one to implement logistically in your life. I'm just describing it and this next one to round out the 4 deep risks. The fourth one is devastation risk. So the risk of war, of natural disaster, of societal collapse that destroys infrastructure or institutions or entire economies. So that might be something like Germany or Japan after the world wars, or Syria or Lebanon or other war-torn countries right now. The defense against that risk would be geographic diversification, foreign real estate, hard currency holdings, and then also, planning for your physical safety. For a truly catastrophic risk, some things go beyond finance. So anyway, in the book, Bernstein talks about building a portfolio where you take into account those four risks. Maybe not in even amounts, it's not a quarter each of your portfolio, but at the very least that you consider those risks. You consider how real they might be in your life, and you consider whether you want to build a portfolio that defends against them. So going back to Dan's question about recession, that's the closest thing here to deflation risk. And again, as I alluded to, cash and bonds are something that you're going to want to pay attention to going into a recession. Specifically, Bill Bernstein talks about long-term treasury bonds, high-quality fixed income like cash or CDs or short-term bonds. And Bernstein admits that a modest allocation to gold, if that's something that you're interested in, that can be worth doing going into a recession as well. So, Dan, those are my thoughts. Personally, I know recessions are possible, and my financial planning process takes that into account, and I'm not going to change anything in my portfolio just because we might enter a recession this year, because that idea, the idea of, we might enter a recession this year, that idea has always been true, right? Every single year since I or you have been investing, that has been true. We might not have realized it at the time, but that risk is always there in the background, and a good financial plan and a good portfolio takes that into account anyway. But if you wanted to tweak something small and specific for the fear of a recession, I'd look into the idea of decreasing your stock allocation and increasing your bond allocation. Okay, listeners, thank you for powering through with me here on episode 108. As always, please send in your questions, your AMA questions to my email, jesse@bestinterest.blog. Awesome ways we get to learn because a rising tide lifts all ships and an investment in knowledge pays the best interest. So thank you for listening to Personal Finance for Long-Term Investors.
Thanks for tuning in to this episode of Personal Finance for Long-Term Investors. If you have a question for Jesse to answer on a future episode, send him an email over at his blog, The Best Interest. His email address is jesse@bestinterest.blog. Again, that's jesse@bestinterest.blog. Did you enjoy the show? Subscribe, rate, and review the podcast wherever you listen. This helps others find the show and invest in knowledge themselves. And we really appreciate it. We'll catch you on the next episode of Personal Finance for Long-Term Investors. Personal Finance for Long-Term Investors is a personal podcast meant for education and entertainment. It should not be taken as financial advice, and it's not prescriptive of your financial situation.